Okay, see, we have some folks here.
I should unmute myself. Hi, everyone. My name is Christina. I'll be the tech support for today's meeting.
Okay. And
Now, I just have a quick question. I see that Hank, you are currently the host of this session. Would you be able to hover over my image, click on the three dots that appear in the top right-hand corner, and assign me as the host? Because I'm going to be kind of managing like the breakout sessions. Yeah.
okay. So I should make you host.
Yes, please.
Done.
Wonderful. Thank you. And I'll actually pause the recording.
Start recording, Christina. Well, hello everyone. Thank you very much for participating in this virtual conference in the ether. At the end of the day, I think it's probably easier to do it this way than trying to get all these people in the bus and in a hotel somewhere and reserving rooms or whatever. So I like this better, quite frankly. We have quite a treat for you today. This is our second conference. We had one last year on campus in November. This time it's becoming more and more of a practitioner conference, I have to say. We've got some interesting guests. We've got people from Lehigh and other universities. Rodney especially is joining us from, Rodney, remind me again, the university?
University of California, Santa Barbara.
University of California. Sorry about that. We've got lots of interesting guests, so I'm not going to introduce them all now because it will take me forever, and then we'll have small chats and it'll take forever. So let me first of all letting you know that this conference is really, there might or might not be any presentations. Some of them do have, but the focus is going to be really on discussion and really expanding the field. You should be surprised at what you hear. You might not like what you hear, but that's okay. I'm gonna, after I'm finished down, Christina, I would like you to give a quick rundown of the rules so that everyone is aware of it. But we'll start first with Hank, Rod, Corey, to talk about decentralized finance and central bank digital currency. So this is like a big topic right now, based on some of the feedback that we've gotten from people wanting to go into the networking session that ranked pretty high. API for financial institution with Brendan and Kate. We'll have Nick with some interesting stuff on data forensics. Then we'll have the future. It's not even there yet, but you get to see it now. We have some interesting research from Thomas and Lewis from the university on quantum computing. Then Dimitri, bit of a star on Quant if you could believe that, more than 13,000 subscribers on YouTube. We'll be talking about stationarity. He's a quant, he's an FRM, and he's got lots of interesting to say. Believe it or not, this topic also ranked pretty high as well. And finally, we'll talk about synthetic data and stress testing with Sri. So, Christina, can you lay down some rules for us before we begin?
Okay, I just wanted to go over some quick Zoom etiquette. That way we can get the conference rolling and everything runs smoothly. We just ask that you keep your microphones muted throughout the session unless you've been called on to speak. And if you do have questions at any point during the session, you can just type them directly into the chat box and we'll notify the speaker and let them know that you have a question. We also ask that when you go out into the breakout sessions, if you have any technical difficulty or can't get in, just do a raise hand in the Zoom function, and then we'll place you in the right spot. If anyone has any questions, just let us know.
So Corey, Rodney, Hank.
Wonderful. Thank you, Patrick. This is going to be, I think, a fun session. I mean, many of you know that blockchain is a big and growing thing in the financial world. A year ago, when we had this conference. Libra was the big thing. Many of you recall it was an association of some, really name brand financial firms and looking to become a global currency, bring banking to the unbanked, a strong, social mission stated there. But they made the somewhat inexplicable decision that of all the name brand companies involved, they put Mark Zuckerberg out there. And the result was a major political backlash. Libra is still, alive and reoriented, but it may not be the #1 topic of discussion right now. For those of you who are really not familiar with the blockchain world, you've no doubt heard of Bitcoin. There are many, many cryptocurrencies and a very strong overall ecosystem. Looking at the list of guests here, I see that the Ethereum ecosystem is really well represented. We have Liz, Zane, Shane. I've seen there some scanning through the list. So, lots of folks who are playing broadly in this space. Our focus in this panel is going to be on two really growing ideas in the intersection of the financial world and blockchain. One of them is the concept of a central bank digital currency, which is, to say it very simply, and Rod will tell us more about it momentarily, it's the idea that a national central bank puts out its own cryptocurrency denominated in that nation's fiat currency. So basically moving the kind of financial system a nation has now into a blockchain, which creates all kinds of possibilities, some perhaps very good, perhaps some that might be worrisome in the sense that it creates a new venue for the currencies of the world to compete for dominance. And some suggest that the emergence of central bank digital currencies might erode or indeed destroy the worldwide dominance of the dollar today, but we'll talk more about that. The other topic we're going to talk about, decentralized finance, is a disintermediating of the financial interactions in a number of really interesting ways. And again, providing the possibility of bringing the power of finance broadly to the populace with less need for banking and intermediaries, also providing some very nice financial, arbitrage, lending, and other services. And Corey will be telling us a good bit about that. So let me very briefly introduce the panelists. If I introduce Rod Garrett completely, it'll take the whole session. He's currently the Maxwell C. and Mary Palish Chair in Economics at the University of California at Santa Barbara. In his star-studded background, probably the most notable thing for this panel is that he is a former vice president of the Federal Reserve Bank of New York, and in that role, he led the Virtual Currency Working Group for the Federal Reserve System. So he has been right into all of this. He's also been an advisor to the Bank of England and has consulted for Payments Canada, so fantastic international experience. And so we'll be looking forward to his input. Corey Kaplan is a Lehigh alumnus. I am proud to say an alumnus of the Computer Science and Business program here at Lehigh. Graduated just over a couple of years ago, and he has two really interesting ventures to his name. One of them is a decentralized exchange, Dolomite, and there he is president and co-founder. And then there is the DeFi Money Market Foundation, DeFi as in decentralized finance, not defiance. And there they have a really interesting decentralized finance ecosystem that he'll be talking about. So I'm going to suggest we start with the central banks. And Rod, I'll invite you to say a few words of introduction, and we will be taking questions. I mean, Corey, shoot out questions anytime, as I will, and those of you broadly in the audience, we'll be looking at the chat, and we'll call on folks as we can fit that in. So Rod?
Yes, thank you. So I guess I should start off by just talking a little bit about what central bank digital currencies are. And so I think, the idea of a central bank digital currency can mean multiple things, and it's a little bit confusing because central bank reserves, specifically the money that banks have in their accounts at the Federal Reserve, are central bank digital currency. That's digital money, but that's not what people mean when they say CBDC. The concept that most people have in mind today, I think, would be some form of central bank issued digital cash. And so cash use is declining around the world. And this is a trend that it has been accelerated by COVID. And many are asking if central banks should replace cash with something digital, either by allowing individuals to have bank accounts at the Fed. This is an idea that's been around for decades, was first proposed by Nobel laureate James Tobin back in the 80s, or by utilizing some other type of technology that might allow this digital cash to have features that are more similar to physical cash. And so blockchain is one possibility, but central banks have also considered things like stored value cards. But the goal with these type of technologies, either blockchain or stored value, is to have something that can be traded in a more peer-to-peer fashion without interacting with central accounts, much like the way we transact in cash. And in fact, there's a history of this. So there was something called the Avant smart card system that was introduced by the Bank of Finland back in the 90s. And this was a stored value card that was issued in order to replace coins and low denomination notes. These cards offered, where they were pre-funded, so you loaded central bank money onto them. They offered anonymity to the user. And so this is, in some sense, this type of idea is really not new. What I would say is new is the idea of approaching this topic from the perspective of using the new blockchain technologies.
Rod, I'll ask you a couple of quick questions here. One of the things that's possible if we put a CBDC on blockchain is that one could implement monetary policy in code. I mean, Bitcoin has done that with a highly deflationary policy. That may not be the one you want, but are there things that might be able to be put in code that might be beneficial from a central bank perspective?
Yeah, so that's a super interesting question. And when I was at the Fed, and first, I was at the New York Fed in 2013, and suddenly the price of Bitcoin rose to around $1,100, $1,200. And so we were all suddenly saying, what is this? And, one of the things, so I was one of the people that was put in charge of figuring out what this was. And one of the first things I noticed was this sort of interesting monetary policy rule that the money supply is issued, there's a certain amount of Bitcoins that are issued every, I think it's $200,000 blocks. And this amount halves, each 200,000 blocks. And so, but the point is that there's this fixed money supply rule. And so from a monetary theorist perspective, this is really quite interesting because we've always had this debate in monetary economics, which has been called rules versus discretion. And this is a debate that economists that you will have heard of, like Stanley Fischer and Milton Friedman and Robert Barrow, Frederick Mishkin, Robert Lucas, all these big names that you will have heard of if you've taken economics classes have discussed this issue and wrote extensively on it, including my colleague, Finn Kidlin, a Nobel Prize winner, who introduced the notion of time consistency to the discussion. But the basic idea is that, markets like certainty. Markets like to know what the government is going to do. And so one way to have certainty is to impose rules. I mean, so the Bitcoin rule for how new tokens are introduced into the system is a fixed rule. And rules can be a great idea, but rules cannot account for all circumstances. So, if you make a rule, you don't know if that rule is going to be good under certain events that might transpire. And in any event, there are often pressures in real systems, or at least in human-run systems, to deviate from these rules. So, Bitcoin follows this strict rule of how money supply is increased. And this was probably pretty key in terms of Bitcoin's initial success, because this aspect of Bitcoin gave people great confidence that no one who exercises poor discretion could basically produce tons of this coin and devalue it. But as I said, this also means that the coin the value of the coin is going to be subject to large fluctuations because you can't adjust its supply to match economic conditions. So the question then becomes, what's better, rules or discretion? And people who argue that rules are better and argue that the Bitcoin system is better often point to examples like Venezuela or Zimbabwe, where the leaders of those countries essentially printed tons of money to the point where the currency became valueless. But these examples, I would argue, are not good examples, at least not for thinking about places like the U.S., where the people that control the money supply have proper incentives. So in the United States, the Fed is an agency of Congress, and its objectives are determined by the people. The Fed has no incentive to print money to the point where the dollar value drops to zero. No one in the Fed system would gain by doing this. And moreover, the Fed has sufficient independence, particularly from the executive branch, to prevent undue political influence. So my feeling is that the US system, which is essentially that you are guided by rules, but you don't follow them strictly, is the best system. And so I think that while it is interesting, this concept of building coins with these fixed monetary supply rules is an intriguing idea. And in fact, I should mention, people have considered more complex rules. There was a coin that people in this audience probably would have heard of called Basis, a proposal for a coin that was going to follow a rule that was very much like the Taylor rule. So in economics, there's a very well-known equation called the Taylor equation, which states what the federal funds rate should be. That's the overnight unsecured money market rate, the rate at which banks borrow and lend from each other. There's an equation called the Taylor equation, which states what this federal funds rate should be as a function of inflation, the output gap, and some target rates. And so the Fed could simply commit to follow that rule. That would be a way to do something that's analogous to Bitcoin. And this is essentially what this Basis coin was proposing. But again, there's been years of debate on this and years of experience. And people believe that the best idea is to allow some discretion. And again, I argue that works the best, again, provided as the people that have the discretion have the proper incentives.
Corey, look like you were about to say something before. Do you want to jump in, Corey? Or?
Yeah, just a quick question. So for those that might be more familiar with the cryptocurrency ecosystem, so I apologize if I'm jumping ahead a little bit. There already exist things like stablecoins that are out there that are essentially currency-backed coins that are pegged to the currency that it's trying to value against. So, for example, USDC or US dollar coin is a cryptocurrency coin that's pegged to the dollar. It was brought online by a consortium involving Circle, Coinbase, Goldman Sachs, and a couple other companies. And right now the notion is if you have 100 of these coins, then you have $100. If you have 150 of these coins, you have $150, so on and so forth. What would you say is the distinction between coins like this that already exist and have somewhat of a market or use case today versus one that's officially backed by the Fed?
Well, I guess I would just say, what would you rather hold? A digitalized version of the dollar that was issued by the Fed, or Tether, right? Because Tether is an example of what you're talking about. And so the difficulty, and I don't mean that, I mean, it is a difficult issue, which is that, so let's back up a little bit. So the first issue is, what is the benefit of issuing these stable coins that are essentially just alternative representations of the US dollar? So people could always already have US dollars. They can have US dollars in their accounts and they can move these dollars around. So why do we need a stable coin that's sole purpose is to represent the dollar? Well, the answer is because that stable coin can trade on different platforms that are not accessible by conventional digital money. And that can be advantageous, and things can be built into those stable coins that basically, smart technology that can be built in that can maybe make these coins trade more safely even than conventional currencies. So there is value in having these stable coins. But if you want them to be truly stable, then you have to believe that the actual dollars, because then they're really just digital assets, right? They're like digital bearer bonds. They're representations of money that's held elsewhere. And so for these coins to truly be stable, you have to believe that that value that's backing them is really there. And that's the tricky part. Because, if a commercial bank offered one of these coins, then if that bank defaulted, then that money might be lost unless that commercial bank could somehow segregate those funds. You could form a narrow bank that might issue those funds. And I think that might be a very close substitute to a central bank issued stable coin. But the bottom line is that the difference is the security of the funds that back the coin. And so how are you ensuring that? So that's the key difference. And there's no better way to ensure it than, if you want the value to be as closely matched to central bank money as possible, then you can't do better than just have the coin issued by the central bank.
Thanks. I'd like to turn in this domain to the political realm, both at the macro and micro level to some sense. I mean, one of the comments often made about CBDC is the idea of changing the competition among currencies. This seems like something that, China is looking to do to try to erode the dominance of the dollar with its strong effort in this space. But then there's also a related question at the individual level. And this one, if you're looking at the chat, you'll see that Liz Cuck of Ethereum Classic Labs posed the question that there's also a question here about how individuals using a central bank digital currency are being treated in terms of the of transparency, of privacy, and perhaps also control. And so I'll ask if you can address that one, and then Liz, if you have a follow-up, then feel free to unmute yourself and follow up on the response.
Yeah, so I think there was a few questions in there, and so let me maybe answer the privacy one first, and then maybe you can repeat any other question that I missed. And
Rod, if you can read the chat in parallel, there's a question there from Liz that you should have.
Okay, let me.
You summarized it well, Hank.
Yeah, so let me just talk a little bit, I guess, first about this privacy aspect. So the idea of introducing a central bank digital currency is really kind of an interesting one, in the sense that it's funny, but from an economist's point of view, we make this big distinction between central bank money and commercial bank money. And so if you think about your deposits at the Bank of America, I'm just making up a bank. What are those deposits? Well, those deposits are you had, say, cash, you deposited in the bank, you loaned the money to the commercial bank. So those are IOUs from that commercial bank. They're commercial bank liabilities. And you believe that if you want to go get a $100 bill, you can walk to that bank and withdraw $100 worth of deposits and convert them into a $100 bill, and you generally can. But those liabilities, your commercial bank money, as I would say, are not central bank money. Those are not liabilities of the central bank. And so we make this big distinction, between whether or not, people need to have central bank accounts. Should they have commercial bank accounts? Should they also have a central bank account? Which is kind of a funny distinction in the sense that I would think most people wouldn't even know what the difference is. Well, one difference might have to do with this idea of privacy. So this idea that when you go to the store and you buy something with your debit card, rightly or wrongly, the Bank of America knows that you bought that item. Well, why should they know? And so, there are plenty of legitimate arguments why you should have privacy in transactions. And I mean, this is something that consumers get benefit from. So as an economist, we look at whether or not we get socially optimal outcomes in which people are getting the privacy they desire, and whether or not economic systems provide this. And so one of the things that a central bank money could provide is privacy. Now, some of you that are listening might recoil at this a little bit and think, like, what on earth do I mean? Well, what I mean is privacy from the commercial banks, or privacy from payment platforms like like Facebook, if Libra were to issue a coin, or so on. Privacy from the private commercial sector. So not privacy from the central bank, but again, my position is that the central bank's incentives are aligned with yours. The central bank is not some entity that exists in opposition to the public. It serves the public. And so you would at least have privacy from people who have an incentive to exploit your private information for commercial profit. And this is something that, you know, Christine Lagarde famously announced when she was the head of the IMF, that the central bank can provide something that commercial banks cannot, that is privacy in payments. And so one argument for CBDCs is this idea of privacy. And I currently have work with Martin Van Oort at the Bank of Canada, which looks at the fact that there's this interesting privacy externality. There's one of the things about privacy is that when you buy something and you do not take actions to protect your privacy, you don't just potentially hurt yourself, you also hurt others that are like you. Because consumer profiling takes your data and it looks at how you behave, and then it responds not only to you, but also to people that look like you digitally. And so people tend to protect their privacy suboptimally in society because they don't internalize the full social cost of not protecting their privacy. And so we have work that examines this issue and talks about what type of government remedies there might be to what is essentially a market failure. And one of these remedies is the idea that the central bank might provide electronic cash. So can I maybe get what the other questions were, and I'll address those as well.
Okay, the other domain, and then we're going to, I want to move over and talk decentralized finance. And Jose Maria, I see you have a question, and I think I'm gonna hold questions on this topic to the networking session later because I want to get DeFi in. But very quickly, Rod, the other comment was at the national level, and you know, the China versus U.S. currency battle that might be fought in this space. And so if you could respond to that briefly, and then I want to let Corey introduce DeFi.
Yeah, so let me think. I do see a quick comment here I did want to answer. There's a comment from Kathleen Hanley that asks about this idea of how cryptocurrencies work for the unbanked. So one of the things that was interesting about the Facebook proposal is it claimed that one of the purposes was to help the unbanked, but there wasn't a lot of details on how they would do that. And so CBDs have been proposed in generally as a device to increase financial inclusion. And one of the reasons for this is very simply that if you look at particularly emerging market economies, far more people have cell phones than have bank accounts. And so the idea of introducing some type of digital currency that people can transact on their cell phones with, you know, barriers to entry that are maybe weaker and than in some cases what's done with commercial bank accounts is a great way to increase financial inclusion. I mentioned earlier this Advent smart card system. So the KYC requirements on these are much weaker, and the way they can make these weaker is they can limit the amounts that are transferred. So, you know, there's no KYC in cash. And so with the central bank providing some digital form of cash, they can do something similar, not exactly the same, but something in the same direction by limiting the amount that can be transacted. And I would like to point to something called Dinero Electronico, which was an experiment that was performed in Ecuador, a CBDC, a mobile CBDC, that was issued from